I started trading a little over 30 years ago, and in that time, I've learned a lot about what works and what doesn't. I think whether you are a seasoned veteran or someone new to trading, some of these things might surprise you, but I'm confident that if you understand these 5 things, you will be a better day trader. So what are we going to start with? Well, I think one of the most important lessons that I have learned is to trade or focus on the hot market. What do I mean by the hot market? It's the one that the crowd is gathered around. Throughout history, throughout my 30 years of trading, there's always been something in play. You know, in the last little while, it's been the energy sector. The energy sector has been hot while the overall market has not been hot. It's been a lot easier to be a trader of energy stocks, of commodity-related stocks lately, because that is the hot market. So how do you know what's hot? It's not that hard, actually. Let's just take a look at the chart and see which sectors are rising from left to right. Let's jump over to a chart of the S&P 500 energy sector, and you can see that it has been trending higher for the last few months. Prior to that, it was going sideways. So during this period here, it's hot. During this period here, it's not. And that is one of the easiest ways to put the odds in your favor. If we pull up a longer term chart of the Russell 2000 index and make it, let's do a 3-year chart here. Some of you may remember that coming out of the COVID crash and into the first part of 2021, it was one of the best markets I've ever seen. Well, look what was happening. The market was trending upward. And that's really all there is to it. If you can go toward the sectors of the market that are hot, that are trending higher, and then trade the stocks in those sectors, you're going to do better. Just that simple. All right, so what's the second lesson? Well, the second lesson is to trade alpha. Now, what do I mean by trade alpha? Stocks that are hot on their own, that are trading on their own story, we call those alpha stocks. They're trading abnormal volume. They are trading with a lot of liquidity. And really what's going on is that there is a crowd gathered around those stocks. Now, every day there are some, and if you can focus on those, then you can really put the odds in your favor, because the crowd gathering there brings emotion and it brings volatility. These stocks are going to make big percentage gains, and they're going to have the emotion that causes them to go up too much and therefore give you a lot of potential for profit. So the way that I find them is I will either run a market scan on the Stockscores.com website looking for stocks trading with abnormal volume and with high liquidity, at least 10,000 trades a day. Let's jump over and just look at an example of one. So for today, one of the alpha stocks of the day was this company, RCAT. This is the daily chart, and you can see that the volume stands out and the price action stands out. And we can scan the market looking for these. But what's more important if you're day trading is to watch what's going on intraday. And that's where it really shows up. This is the previous day, and this is today. It's very obvious. The volume today is significantly higher than the previous day. The stock has come alive. And that presented all kinds of trading opportunities. There was a breakout here from a little ascending triangle pattern. There was a breakout here from a pennant pattern, another ascending triangle pattern, and then you had a head and shoulders top, which meant that the story was probably over for the day, and ultimately the stock went sideways. So trade alpha. Focus on those stocks that are trading with abnormal volume, strong liquidity. It'll tend to be the stocks under $10, $15, because that's the ones that have the more excitement. And so those are the areas that you want to focus on if you're going to beat the market. All right, let's go into number 3, minimize emotion with process. What do I mean by this? Well, we humans have a problem. We avoid pain and we pursue pleasure. We're actually built to avoid pain. We have this little thing in our brain called the amygdala, which causes us to run away from things that are dangerous. Now, of course, if you're being chased by a bear, the amygdala is a good thing. It makes us run even faster. But in the market, we confuse the danger of a bear with the risk of losing money, the emotional attachment that we have with money. And what happens is that thinking part of our brain turns off and the fight or flight part of our brain, the amygdala, turns on. And we don't think very well. To overcome that, we have to do a few things. Number one, we have to not take on more risk than we are comfortable with. If we do that, we're less likely to feel that pain, that fear of taking a loss. But I think one of the most important things that's really overlooked, and something that I overlooked for a long time, is having a process that takes the emotion out of trading. And what I mean by that is a very mechanical, step-by-step process, like a plan that you can follow, sort of a paint by numbers of how you're going to move through the trading day, how you're going to evaluate individual stocks, the things that you can do to have less emphasis on thinking and more emphasis just on doing what you do. It's like if you were a golfer, you don't practice your swing on the golf course. You're not working on new things on the golf course. You do all your training outside of your normal game so that when you get to the game, it's just this mechanical process to do what you have practiced and learned. And the same thing for trading. You want to develop a mechanical process in the evenings, on the weekends, while you're just learning how to trade, so that when you're actually putting real money on the line, you're not having to think a lot anymore. You're just putting forth this strategy, this process that you've developed, that you believe in, and that you can do with some mechanical repetition so that you don't make those emotional mistakes. Trade with an edge. Well, what do I mean by that? Trading with an edge means if you're going to do well in the market, you have to have an advantage over most other people in the market. See, the stock market's very efficient. It prices in new information almost immediately. It moves very quickly in terms of opportunities play out sometimes very quickly. So you need something that gives you an advantage over everyone else. Now, like an institutional trader, you sometimes hear about high frequency traders. Those are these large investors that have very, very powerful computers that can fill trades in microseconds. Their advantage is speed, right? And the thing that they are doing to pull money out of the market consistently is to have an edge with the speed of their computers, with the speed of their communication systems. Their access to the markets can be very, very quickly. That's their edge. Someone who is an expert in the oil and gas sector has an edge because they have better information. They have more knowledge. I don't know anything about oil and gas. I don't have the kind of speed that a high frequency trader has. My edge is that I've developed my own algorithms using my own indicators that allows me to get into these new hot stocks, these alpha stocks, before everyone else. On screen right now is a dashboard that I have. So I run a program called TradeStation, and this is a screen from a service we have at Stockscores.com called Active Live. And what it is in real time an algorithm that is calculating or searching for stocks that come alive with abnormal activity. And so in the last 30 years, I've been developing my method. And my edge now is that I've got something that most people don't use. I'm not using normal technical analysis indicators. I built my own. And so because most people aren't using it, we have an edge. And I can find the hot stocks before most other people. Now you can use my edge if you're one of my students, but of course you can also develop your own edge. Whatever you want to do, just make sure you have something that gives you an edge in the market. For some people, it can also be just better psychological makeup. Maybe you deal better with fear, deal better with greed. That is something that makes some traders very good at what they do. Some people have powerful computers, some people have better information. Find your edge and you will do better in the market. All right, next up, limit losses the right way. Well, we should always limit losses. We talk often about having stop losses. But I would say that this is one area that people screw up more than anything else. We know that we shouldn't take big losses, but the problem is we tend to, or many traders tend to, use stop losses that are too tight. You have to give stocks wiggle room. So I hear people sometimes say, oh, I'm going to always take a loss if the stock goes down 3%. Well, why 3%? You know, does 3% make sense for Microsoft in the same way that it makes sense for some $3 biotech stock? No, that $3 biotech stock is much more volatile than something like Microsoft or Amazon, these large cap companies. So using percentages for your stop is a bad idea. Don't do that. What you need to do is look at the chart in the context of the trade that you are making and judge your stop loss point based on the opinion of the market. So let's go back to that RCAT stock that I was talking about earlier. If we're going to buy this stock right here because it's breaking out of this little pattern, okay, simple technical analysis, stock goes up, it's trading abnormally. I would find that using my algorithm early on. I'm watching the stock for a good pattern, okay? Breaks out of that pattern just a little after 10 a.m. on the 14th of March. Where do I put my stop? Well, one of the most common problems is to put the stop way too tight. And then you end up getting stopped out even though you are right. You can't tailor your stop based on how much you want to lose or the maximum amount you want to lose. What you have to do instead is look to where there is a market opinion defining a floor price on the chart. So in this case, I would say there was a floor price right here. That's just below the point where the stock took off. So in this case, that's at about $1.90. All right, another thing, don't put stops at even values. $1.90, bad place to put a stop. Put it at $1.89, $1.88, because there will be a wall of buyers at psychological thresholds. People tend to say, I want to buy at $1.90, and there'll be a whole bunch of buy orders stacked up there. So if you have your stop just a little bit below that little wall, then you're less likely to get stopped out. And then what you do is you use the difference between the price that you're paying and where the stop loss point is, and you use that to define how big your loss will be. You might be wondering, how do you do that? Well, if you're buying at $2 and your stop loss is at $1.88, you've got 12 cents a share in risk. If you buy 1,000 shares, you stand to lose $120 plus commissions and maybe some slippage. Maybe it's $150. You know going into the trade what your loss exposure is. And this goes back to that other part about controlling emotion. If you know that you can lose $150 on a trade and you're comfortable with that, you're less likely to get emotional. You're less likely to make stupid mistakes because you're going to keep that amygdala part of your brain out of the equation. So there it is, 5 little things that I've learned the hard way. What have you learned? Leave a comment. Let me know some of the hard lessons that you've learned, and maybe we'll do a follow-up video. If you get lots of likes on this video, I'll be happy to do that. So like the video, leave a comment, subscribe to the channel, and most importantly, trade well.